There's this basic intuition we all sort of bring to the stock market, right?
Yeah, for sure.
Like if a company completely dominates a really vital, rapidly expanding sector, say advanced combat drones and, space defense.
Right, the really high-tech stuff.
Exactly. And they're boasting this massive double-digit revenue growth with a staggering $4 billion backlog of guaranteed orders.
Look, is huge.
Yeah, it's massive. You would probably expect their stock chart to look like, I don't know, a steady climb straight up a mountain.
You'd think so, yeah.
But occasionally you encounter a situation that just breaks all the conventional rules. You find a company where all those glowing billion-dollar fundamentals are present, but the stock chart looks like it's in a brutal, unrelenting freefall.
Yeah, it creates a really severe cognitive dissonance.
Totally.
You're staring at the fundamental reality of a booming business, and it is completely detaching from the technical reality of the stock price. It forces you, as an investor, to question whether the business models are just wrong, or if the market is just behaving totally irrationally.
And that is the stark contradiction we are dissecting today, April 21st, 2026.
It's a fascinating one.
It really is. We're turning our attention to Kratos Defense and Security Solutions, ticker symbol KTOS. As of yesterday, the stock closed at $69.83.
Which is rough.
Yeah, it's just the latest print in a very painful, very sharp pullback from the massive highs it hit earlier this year. So our mission for this deep dive is to figure out if this defense contractor is like a wildly undervalued hidden gem ready to reward patient investors, or if it's a dangerous value trap perfectly engineered to crush an unsuspecting portfolio.
Right. And to get to the bottom of that, we have to look purely at the mechanics driving this price action.
Strip away the emotion.
Exactly. Completely strip it away.
Whoa.
We need to tear into the balance sheet to understand their cash position, decode the algorithmic selling pressure on the technical charts, look at the institutional order flows, and fundamentally understand how Wall Street is pricing defense tech right now.
Real quick, though, before we get into all those numbers, if you are enjoying this deep dive, make sure to like the video, subscribe to our YouTube channel, and definitely leave a comment with your feedback. It's compulsory. We want to hear from you.
Absolutely. We love the comments.
Okay, so let's unpack this a bit. Let's start with the bipolar reality of this stock, because the gap between their top-line glory and their bottom-line pain is just jarring.
It really is.
Just looking at the last 52 weeks, the volatility is staggering. I mean, the stock had a 52-week low of $31.48.
Right.
Then it goes on this monstrous run, surging up to an incredible $134 by January 20th of this year.
A massive breakout.
Massive. And now, less than 3 months later, it has essentially been cut in half, sitting right around that $69.83 mark.
Yeah, and a $100 swing in a single year for a defense contractor is it's highly unusual.
Unheard of, really.
Right, because the defense sector is traditionally viewed as this haven for steady, boring dividend payers.
Yeah, like Lockheed or Raytheon.
Exactly. Companies that build aircraft carriers or missile silos, they usually trade on very predictable, slow-growth trajectories.
Right.
But Kratos is trading with the violent volatility of an early-stage, high-growth software startup.
And when you look at their 2025 income statement, they certainly look like a high-growth company.
On paper, yeah.
Right. They posted total revenue of $1.347 billion. That's an 18.5% increase year over year.
Which is fantastic growth.
And they finished the year really strong with the fourth quarter hitting $345.1 million. That represents 20% organic growth.
Yeah.
But, this brings to mind a specific scenario. Imagine you live down the street from this trendy, booming restaurant.
Okay, I'm tracking.
Every time you walk by, the line is out the door. The tables are packed. The kitchen is frantic. The waiters are rushing around. You just assume the owner is absolutely swimming in cash.
Because it looks so successful.
Right. But at the end of the month, you find out they can barely make rent.
That is actually a perfect framework for understanding Kratos right now.
Because despite bringing in that $1.347 billion in revenue, their actual net income was a tiny $22.0 million.
Wow.
Yeah, that comes out to just 13 cents of diluted earnings per share.
It's tiny.
So the kitchen is pumping out orders, but the profit left on the plate is almost microscopic.
Well, the cost of fulfilling defense contracts is immense, right? And that restaurant analogy scales up perfectly here.
How so?
It's not that Kratos is failing to sell their products.
Yeah.
It's that the cost of engineering, manufacturing, and delivering those products is just incredibly high.
Oh, like the raw materials and stuff.
Exactly.
Yeah.
Defense hardware involves highly specialized aerospace materials, rigorous testing protocols, constant technological revision.
Right.
And when we look at their cash flow, it adds another layer to your restaurant owner's dilemma.
Go on.
The owner isn't just paying high food costs. They are simultaneously trying to build 3 new kitchens in the back to prepare for next year's menu.
Which totally explains the negative free cash flow.
Precisely.
For fiscal year 2025, Kratos had negative free cash flow of $137.4 million.
Yeah.
So they brought in over $1 billion, but more cash actually went out the door than came in.
Right, and that negative cash flow was driven entirely by massive capital expenditures and R&D.
Research and development.
Right. To stay ahead in the modern defense sector, specifically with advanced tech like tactical autonomous systems and space communications, you literally cannot afford to stop innovating for a single quarter.
You'd fall behind instantly.
Exactly. You are building new manufacturing facilities, securing supply chains for rare earth metals, paying top-tier aerospace engineers.
It's expensive.
Very. So while the income statement shows incredibly tight margins, the cash flow statement shows a company aggressively investing in its own future capacity.
But the immediate thought for any investor seeing a company burn $137 million a year is runway.
Actually.
Like, when do the lights go out? If you're aggressively expanding but the profits are microscopic, that usually puts a company in a very dangerous financial position where they have to take on toxic debt or issue new shares, which dilutes the current shareholders.
Yeah, that's the natural fear.
Yeah.
But this is where the balance sheet actually provides a massive safety net.
Okay, good.
Kratos is in no danger of insolvency. If you look at their most recent quarter, they have total assets of $2.47 billion compared to total liabilities of only $470.9 million.
Wow, so they have 5 times as many assets as liabilities.
Exactly.
And looking at their liquidity, they're sitting on a massive pile of cash, $560.6 million to be exact. That means even with a negative free cash flow of $137 million for the year, they can sustain this aggressive R&D burn rate for years without needing to tap into expensive credit markets.
They've built a fortress balance sheet. They can weather the storm and continue funding their expansion entirely in-house.
But wait, if they have $500 million in cash, double-digit revenue growth, and a $4 billion backlog of orders, the business itself is structurally sound.
Very sound.
So the panic seems strictly confined to the market's perception of the stock. Why has the stock price dropped from $134 down to $69 if the company is hoarding cash and growing revenue?
You know, what's fascinating here is that the stock market is heavily algorithmic and entirely forward-looking.
Okay.
Right now, the technical charts are telling a story of intense, systematic selling pressure. From a purely charting perspective, the short to medium-term outlook has turned strongly bearish because Kratos has broken below several critical moving averages.
Okay, let's focus on the mechanics of that. You have the short-term 5-day moving average, the medium-term 50-day moving average, and the crucial 200-day moving average.
And Kratos has fallen below all of them.
All of them.
I know.
For anyone who hasn't stared at a trading terminal, the 200-day moving average is often treated like the ultimate line in the sand between a bull market and a bear market.
Right.
It's the average closing price over roughly the last 8 months of trading. Slipping below that level, which currently sits at $80.16, isn't just a psychological bummer.
No, not at all.
It literally changes the mechanics of how the stock is traded.
Because the modern market is dominated by quantitative funds and risk management software.
The algos.
Exactly, the algorithms. Those algorithms do not read the glowing revenue reports or care about the underlying drone technology. They strictly read trend lines and momentum.
Wow.
Think of a moving average as the collective consensus of value over a specific time frame. When an asset falls below that long-term 200-day consensus, institutional software automatically initiates sell protocols.
Just blindly selling.
Yeah, it strips human emotion out of the trade and just starts dumping shares to limit downside exposure. It becomes a self-fulfilling cycle of downward momentum.
And we are seeing that downward momentum clearly in the technical indicators.
Absolutely.
Like the MACD, the moving average divergence is showing a bearish crossover right now at negative 0.85.
Right.
Instead of just looking at the negative number it spits out, I like to think of the MACD like a car's speedometer versus its tachometer.
I like that.
The stock might still be moving forward over a multi-year time frame, but the engine is currently shifting into reverse. The short-term momentum has completely crossed under the long-term trend, signaling that sellers have taken the wheel.
And we see the exact same exhaustion in the Relative Strength Index, or RSI.
What's that sitting at?
Kratos is hovering around 37.08.
Okay.
Now, the RSI measures the speed and magnitude of recent price changes. Generally, once the RSI dips below 30, an asset is considered mathematically oversold.
Meaning a bounce is coming?
Usually, yeah. The selling has been so intense that a temporary bounce is expected. But sitting at 37 means Kratos is approaching the floor, yet no buyers are stepping up to catch it.
So no reversal yet?
No sign of a reversal at all. The sellers are still dictating the terms of every trade.
And seeing the division president, Philip Karai, sell about 6,500 shares, which totals nearly $500,000 worth of stock right in the middle of this downtrend, feels like a massive red flag.
It definitely looks bad at first glance.
Yeah, because the immediate human reaction is to assume executives are abandoning ship because they know something terrible is coming in the next earnings report.
Right. But digging into the SEC filings, this wasn't an impromptu panic sell. It was actually executed under a 10b5-1 trading plan.
Ah, okay.
Right.
Which completely shifts the narrative around that specific transaction.
Exactly. Executives set up these 10b5-1 plans months or even years in advance to systematically sell off portions of their stock compensation.
Just to avoid insider trading accusations. Right?
Yeah. Yep. They pick a future date or a specific price threshold, and a broker executes the trade blindly. It is an autopilot sale, not a reaction to current events.
Got it. So the executive selling is pre-scheduled, but the massive volume driving the stock down from $134 to $69 is very real. That requires heavy institutional selling.
It does. What we are witnessing is aggressive institutional profit-taking.
The smart money.
Right. Remember, this stock was trading at $31 last year. When it surged up to $134, a lot of large hedge funds and institutional investors saw massive market-beating gains.
So they cashed out.
The smart money decided to cash out their chips and rotate that capital into other sectors. And when institutions sell, they don't sell 100 shares at a time.
No, they dump huge blocks.
Exactly. They sell in massive blocks. That creates a tidal wave of supply on the open market, completely overwhelming the retail buyers.
And institutions rotating out and taking their wins leaves Wall Street analysts in this massive tug-of-war over what Kratos is actually worth today.
It's incredibly polarized.
Yeah, you have an incredibly divided analyst community. The consensus rating right now is a moderate buy. You've got one strong buy, 16 buys, and 5 holds.
Right.
And they have the sky-high average price target of $116.75. That implies massive upside from the current $69 level.
Huge upside.
But then you also have vocal bears, like the analysts at Argus, slapping targets as low as $67 to $85 on the stock, projecting further downside.
Yeah, the massive spread between a $67 target and a $116 target shows just how uncertain the financial modeling is right now.
Nobody agrees.
Right, because valuing a defense tech company with high revenue and low margins is incredibly difficult.
But here's where it gets really interesting. Let's talk about the elephant in the room regarding that valuation.
Okay, let's do it.
Kratos is currently trading at a PE ratio, a price-to-earnings ratio of roughly 524.
Yeah, it's wild.
That is 524 times its earnings. Buying Kratos right now feels like a professional football team offering a record-breaking, multi-hundred-million-dollar contract to a rookie quarterback who has never played a professional game purely on the assumption that he will win 5 consecutive championships.
That's a great way to put it.
A 524 multiple is priced for absolute flawless execution.
Oh, yeah.
The slightest delay in a government contract or a single misstep in manufacturing, and that premium just implodes. How can anyone call a stock with a 500-plus PE undervalued?
Well, the rookie quarterback analogy is perfectly applied here, because if you rely on traditional backward-looking valuation metrics like the PE ratio, Kratos looks astronomically overvalued.
Right, it's crazy.
Paying $524 for every $1 of net income generated last year is mathematically absurd in a vacuum.
Totally.
But institutional buyers are not paying for what Kratos earned last year.
They're paying for the cash the company will generate a decade from now.
Precisely. And this is where alternative valuation models like discounted cash flow or DCF models come into play.
Okay, break that down for us.
A DCF model estimates all the future cash a business will generate over its lifetime and discounts that cash back to its present value today, adjusting for the time value of money and interest rates.
Right.
Models run by platforms like Simply Wallcent, factoring in the company's massive backlog and future growth trajectory, actually suggest the stock might be trading significantly below its long-term fair value.
Okay, so let's examine the actual arguments feeding those models. The bulls have some heavy artillery on their side, starting with that $4 billion backlog.
It's massive.
That is not a speculative pipeline. That is guaranteed future revenue sitting on the books waiting to be fulfilled.
Yep.
Add to that the massive $447 million Space Force contract they recently secured. Space is clearly the new frontier for defense spending, and Kratos is deeply embedded in that infrastructure.
And the bull case also heavily relies on their absolute dominance in the unmanned aerial systems market.
The drones.
Right, they're not just making off-the-shelf surveillance drones.
They are building the XQ-58 Valkyrie. It is a tactical, autonomous combat drone designed to operate alongside crewed fighter jets. We are witnessing a massive geopolitical shift, where militaries are moving away from risking $100 million crewed aircraft, opting instead for fleets of highly capable, relatively cheap, AI-driven drones.
And Kratos is positioned right at the bottleneck of that supply chain.
All right. So bulls are modeling a 100 basis point expansion in their EBITDA margins for 2026. If they can just get slightly more efficient at building these drones, that tiny $22 million net income scales exponentially.
Yeah, but that assumes a lot of things go perfectly.
It's true.
The bears have an equally compelling argument, and it is focused entirely on the friction in the system.
What are the bears looking at?
They point out that the unmanned systems segment, which is supposed to be the crown jewel of their growth narrative, is actually projected to see flat sales in 2026.
Ouch.
Yeah. If the star rookie quarterback stalls out in his first season, a 5.24 PE ratio is completely unsustainable.
And the bear case is also hyper-focused on the supply chain realities, right? Hardware manufacturing is brutal right now.
It really is.
We discussed how incredibly tight their margins already are. If the cost of specialized aerospace metals, microchips, or advanced sensors goes up, it could crush those delicate margins entirely, instantly erasing that projected 100 basis point gain the bulls are hoping for.
And consider the macroeconomic environment right now. When you have a valuation multiple that high, you are incredibly sensitive to interest rates.
Right, because borrowing costs go up.
Exactly. If rates stay elevated, financing those massive R&D projects becomes more expensive. High multiple growth stocks are always the first to get punished when the cost of capital rises, regardless of how cool their drone technology is.
Right, and if we connect this to the bigger picture, this volatility and high valuation create an incredibly dangerous environment for everyday retail investors, don't you think?
Oh, absolutely.
Yeah.
There is a psychological trap here that catches people constantly. It's a cognitive bias known as anchoring. A retail trader looks at the chart and says, Kratos was trading at $134 just 3 months ago. Now it is at $69. It must be on sale. It's half off.
Right, right.
They anchor their perception of true value to that all-time high.
But a stock dropping 50% isn't automatically a bargain.
Not at all. They fundamentally underestimate the mechanics of a high PE stock. A stock trading at 500 times earnings doesn't just bounce back to its highs because it's cheaper than it used to be.
It's reevaluating.
Exactly. It reacts violently to the slightest whisper of margin compression or supply chain shocks.
Yeah.
If they miss an earnings estimate, the stock isn't on sale. The market is aggressively recalculating its future potential. It's undergoing a structural re-rating.
It's the classic definition of trying to catch a falling knife.
Oh, yeah.
You step in thinking you're outsmarting the market with a bargain, and you just end up taking the losses the institutions are leaving behind.
Exactly what happens.
So what does this actually mean for the immediate future? Where is the battleground over the next few weeks?
In the short term, the outlook remains neutral to down. The algorithmic momentum and the heavy selling pressure are simply too strong to ignore right now.
Okay.
But there is a massive catalyst looming. The upcoming earnings report scheduled for May 6, 2026.
Oh, wow. That earnings report is going to be the absolute crucible for this stock.
Completely. Heading into May 6th, there is a critical technical line drawn in the sand. The stock absolutely must hold the $68 support level.
What happens if it breaks below 68?
If it breaks below 68, the technical damage could trigger a further algorithmic collapse as systems search for a much lower baseline.
And if they have a good report?
Conversely, if they deliver a strong earnings beat and show actual margin improvement, the stock faces an immediate path up to overhead resistance at $86.
Okay, so the short-term horizon is fraught with severe technical risk.
Very much so.
But if we zoom out and look at the long-term horizon, say a 3 to 5 year holding period, The narrative changes dramatically.
It really does.
The geopolitical realities acting as a macro tailwind for Kratos are undeniable. Global defense budgets are rising rapidly in response to global instability.
Yeah.
The nature of warfare is fundamentally shifting toward the exact autonomous aerial systems and space-based communications that Kratos builds. Management is targeting massive organic growth of 18 to 23% by the year 2027.
Right.
If they execute on that vision, the current valuation debate will eventually resolve in their favor.
It's the ultimate stress test of an investor's timeline and risk tolerance.
It really is a tale of two distinct timelines. In the short term, you have a stock chart that is technically broken, profit margins that are incredibly tight, and institutional money taking profits and running.
Yeah.
But underneath all of that technical damage, you have a business generating over $1 billion in revenue, hoarding $500 million in cash, sitting on a massive $4 billion backlog, and literally building the AI-driven combat drones of the future.
So crazy.
The business is fundamentally thriving while the stock is technically broken at the exact same time.
It is a complex puzzle, and it requires looking past the daily ticker tape to understand the underlying mechanics of the aerospace industry.
Totally. And as we navigate these complex financial puzzles, we just want to remind you that this deep dive is an exploration of the data, the balance sheets, and the diverse perspectives out there on Wall Street.
Right. Just looking at the facts.
We're here to help you unpack the mechanisms driving the market, but this is not financial advice. Always do your own research, assess your own risk tolerance, or consult a professional before making any moves in your portfolio.
Yeah, and I think this raises an important question, a potentially explosive new question for the broader defense sector.
What's that?
We know the legacy prime contractors, the massive, slow-moving behemoths building traditional fighter jets and aircraft carriers, are watching the nature of warfare shift rapidly toward cheap, autonomous drone swarms.
Right.
They desperately need the technology Kratos possesses. If this stock price continues to bleed and the market cap shrinks further, Kratos might not just be a value trap or a hidden gem.
Oh.
It might become the most attractive takeover target in the entire aerospace sector. Will a larger prime contractor swoop in and buy their next-generation technology at a steep discount?
That is the ultimate strategic wild card. The restaurant might be struggling to pay rent right now, but a massive corporate chain might just buy the entire building for the recipe.
Exactly.
Well, thank you so much for joining us on this deep dive into Kratos. Keep questioning the numbers, keep looking past the surface, and we will catch you on the next one.